Hi, I'm Tom Lydon in Hollywood, Florida at the Inside ETF conference here with Jay Pelosky, co-founder and CIO of TPW Investment Management. Great seeing you, Jay.
Good to see you, Tom.
So let's talk about the Fed and interest rates. All of a sudden they took the foot off the gas. Are they going to put it back on the gas?
I don't really think so. I think the Fed is on hold for a while. I think this pause is going to last at least for the next 6 months. And I'm actually a believer, Tom, and here's something people are not talking about. We're at the beginning of a global easing cycle. So it's not just the Fed, it's the other central banks around the world that have been tightening, particularly in the emerging markets, which had to protect their currencies last year. I think they're going to start to cut, and I think that has big implications for asset prices.
What's going to make that happen?
Well, I think we're in a sense where the global economy has slowed, right? We're worried about China, we're worried about Europe, we're worried about Japan. These central banks have some capacity to cut because they hiked rates last year to protect their currencies. So I think it's not going to be led by the Fed, it's going to be led by some of the emerging market central banks. And if you look on a global basis, there've been the number of central bank tightenings are at a level that suggests historically that we're about to start the easing cycle and banks are about to start to cut.
So, for example, if China or the UK, for example, cut first, do you feel there's pressure on the Fed to follow?
I don't think the Fed needs to follow necessarily, but I think the Fed has signaled to the market that it's going to wait and observe. The Fed is very leery. I think the difference in the Fed in the last couple months is that they took the message that markets have created the last 2 recessions, okay? And they saw December and they're like, we don't want to do that again. Yeah. So we're going to take our foot off the gas. We have enough room now that we've raised rates 9 times, right? It was the longest tightening cycle in US history. So it's been going on for a while. And I think they can observe here, the US economy is going to slow, but I believe towards its potential growth rate of about 2%, no recession, but the rest of the world, China needs to bottom. If you want to see asset prices go higher, we need a couple things, right? Fed on hold is one, we've got that. China trade deal is likely, I think that's coming, that's 2. And then we need to see the economies bottom in Europe and in China, and I think easings in the rest of the world can stimulate consumption, can stimulate demand, and help those economies.
So, in closing, investment strategy, emerging market bonds, that a buy?
Yes, that is definitely a buy. We like both the dollar-denominated bonds and the local currency bonds. We also like China, Latin America, Europe, and Japan. Okay. Not so much the US. We're underweight the US, overweight the rest of the world.
Excellent. Jay, thanks for coming by. Great seeing you.
Great to be here, Tom.
Thanks.